Hey, good morning, everyone. Marty Missouri here, March 11th, 2023, with your weekly economic update. Big week last week, or interesting week, to put it mildly. It was quite the week for markets. It was quite the week for the banking sector. With regard to markets, particularly because of what went on Friday and my last snapshot I actually recorded for you on Thursday, although emailed it to you yesterday. I think I'll go ahead, time permitting, this weekend, so I hope to be able to update the snapshot. Obviously, enough happened on Friday that it'd be worth sharing what I'm seeing in the charts. But didn't want to add it to this because I'm thinking some commentary around the banking space would be good to close out this presentation with. But we'll start as usual with a quick look at our index. We dropped 2 points on the week to rounded up to 27. Currently, only 22% of our inputs are scoring positive, 49% are scoring negative, 29% are neutral. So, folks, our view is we're living in an economy where recession odds going forward far outweigh the prospects for continued expansion right here. Each week, I grab a handful of our 45 inputs and share those with you. And this week, I want to start with weekly jobless claims. You can see we have a higher low here, not a good sign. Now, some people will say that you just don't have a recession when you have such strong labor numbers. Well, when you look at claims, okay, but boy, when they start to turn up, you do need to start thinking about it because, you can see right here, you could have said, hey, weekly claims are, at least historically low. I think you could even say that there. And then look right when they started ticking up, boom, we're in recession. Oh, just months before, we're in recession, right? We're in recession right here, right on the cusp. So at least history suggests when it comes to weekly jobless claims that no, low claims by themselves at any given time do not necessarily suggest low recession risk. I'll come back to jobs here in a second, but taking a look at retail sales, we have the monthly data, and then we have the higher frequency red book information, and you can see that's really dropping in terms of the growth rate down to 3%. This is a trend that very much jives with our overall view of where the economy is likely to be heading here going forward. Okay, back to jobs. The monthly non-farm payrolls data was out. 311,000 new jobs were recorded. That was ahead of expectations. However, the household survey suggested that job numbers had fallen, and that's where we capture the unemployment rate, which actually ticked up to 3.6 from 3.4. Average hourly earnings, the month over month, that's the one that speaks to inflation, and that was less than expected. So the market actually welcomed that, even though we had a pretty good down day yesterday. For a while there, the market was trading higher. The quits rate dropped to 2.5 from 2.7. Remember, a high quits rate is considered bullish for the economy because people don't tend to just quit their jobs unless they have something attractive in the offing. Job openings came down a little bit, still high at 10.8 million. The labor force participation rate actually ticked up a little bit. And then U6, which captures discouraged workers, part-time workers, and so forth, 6.8%. And that looks like that ticked up just a little bit as well. So this was going to be big news, I had thought, for the market. And of course, that just got completely overwhelmed by the news around Silicon Valley Bank. Again, I'll talk about that here in a second. Commercial and industrial loans continue to roll over, now in negative territory. Definitely not a positive sign with regard to the state of the economy. Remember, whenever you see a red shaded area on one of these charts, that's a recession, right? So you can see what the trend tends to be leading to recession. And again, this is a notably negative look right here. The Bloomberg Commodity Index continues to roll over. Things like falling commodity prices and certainly rising recessionary risks, those are disinflationary factors as well. We don't need to get into this for the umpteenth time, but as clients certainly know, and regular readers and viewers of the blog certainly know, we have a structural inflation thesis, or we're in that structural inflation camp, that says that inflation is going to be higher for many, many years to come, certainly relative to what we've grown accustomed to over the past few decades. But right now, given the dynamics around the economy as we sit here today, certainly inflation is going to come off the boil, or I should say odds certainly support the notion that we're going to see the rate of inflation come down noticeably over the next few weeks and months. Now, there's also the base effects to talk about. I'm going to read from Bespoke Investment Group's weekly report. On Tuesday, we'll get another batch of information data in the form of the Consumer Price Index for the month of February. Last month, we only saw a small decline in the year-over-year headline reading from 6.45 down to 6.41, but we're due for a solid drop this month as higher readings from a year ago roll off. Right now, estimates are for headline CPI to rise by 0.4% month on month in February. If that number comes in line, the year-over-year reading would drop to 5.87%, which would be below 6% for the first time since September 2021. If we were to see 0.4 month-over-month prints on each month going forward out to June, the year-over-year CPI reading that month would be all the way down to 3%. There's a real scenario where year-over-year CPI gets down to 3% or even lower by this summer. Right now, futures pricing has the Fed funds rate much higher than that. This means real rates would be excessively high at 100 to 250 basis points. One thing they don't mention later in the year, all things being equal, those base effects are actually going to lead to significantly higher CPI readings. Now, again, later in the year, we may be struggling to get out of recession, so I suspect that that will be offset to some degree. But if I continue to do what they just did and said on a certain level of month-over-month inflation, it would turn right around and give you a higher reading based on base effects. So as these things come through, we're going to have to calculate how much of that was base effects, how much of that was real disinflation in the economy, if any, to really understand what's going on. The Baltic Dry Index, though, really flies in the face of lower commodity prices, and it flies in the face of our disinflation narrative, which is really quite interesting. So this morning I grabbed the World Container Index, which reports actual spot rates for major east-west routes. It's fallen to the floor. I mean, that's back to a 2020 low before the big spike happened. So I decided I probably should go to the source and see what they're actually saying from their latest report. A stronger week overall, as the North Atlantic appeared active with more inquiries since the middle of the week, with fresh tonnage getting tighter. The time charter trips for both front haul and transatlantic runs had the biggest improvement amongst all routes, finishing the week at 16,639 and 29,344 respectively. The Pacific kept its steady pace as the West Australia to Qingdao run stepped up to a peak so far this year and last seen before Christmas last year. South America saw a mini splurge midweek, with end March arrivals capturing better numbers. Asia witnessed a firmer week with all origins coming alive and finding support. Indonesia saw a healthy pickup in activity, ably supported by good grain and mineral demand. LME tonnage were comfortably achieving 15 to 16,000 levels for trips via Indonesia to China. And just kind of scrolling through other routes, pretty much the same narrative. So the Baltic Dry Index actually does speak relatively positively to the state of the global economy. And the Economic Surprise Indexes, I'm not featuring that chart here today, but I did look at it as we do each week. They're all elevated. Yeah, China is unusually high. As I tell you each time, doesn't mean the economy is just roaring. It just means that it's better than what economists had anticipated. So who knows? It'll be interesting to see if this all holds and we actually see these kind of data begin to rise in the weeks and months to come. Clearly, that's from what I've been sharing with you. It's probably not our base case. The last two inputs, the stock to bond ratio using the S&P and using TLT, our long-term treasury bond ETF, which, by the way, we did add to. I'd mentioned some stock sectors that we added. We also did add to both intermediate, and long-term treasuries, which comports with our recession thesis over the last couple of weeks. As you can see, the stock-bond ratio has fallen off a cliff, meaning bonds here of late, really just this last week, dramatically outperformed the stock market. That speaks negatively, of course, to the state of the economy. And then our staples to discretionary index, consumer staples companies sell you the goods you got to buy to keep alive. Consumer discretionary companies sell you the goods that you want to buy when you have extra money. Discretionary on a year-to-date basis is still notably outperforming staples, but over the past week, as you can see here, staples showed quite the outperformance over discretionary. And then lastly, folks, I thought I'd just throw up the dollar because I think to some it felt panicky the last Thursday and Friday in the markets. And remember, when the world's in panic mode, typically the US dollar rises. Now, this was a very US-centric occurrence with Silicon Valley Bank. But as you can see, here at the end of the week, the dollar really rolled over. That would be reflective of what presently, certainly our view is, of what the dollar is currently trading on. Remember, different currencies, different sectors, different commodities trade on different things at different times. And right now, the dollar is trading on interest rates. Here is the 10-year Treasury yield, which closed the week at 3.69, call it 3.70. So clearly, this explains the late week decline in the dollar. Okay, so closing up here, what I want to do is I've been taking lots of notes around the Silicon Valley Bank scenario. So I'll read from my notes here. And this one here I just copied and pasted from Bespoke. So what happened at Silicon Valley Bank that led it to become the second largest bank failure in U.S. history? First, it's important to understand that the bank didn't suffer the sort of collapse in loan performance that is the typical source of doom for banks. Loan loss reserves are only 0.86% of their total loan portfolio, which is a remarkably low rate and one that isn't possible for a bank sitting on top of a mountain of bad loans. The bank also didn't rely on heavy leverage. 13-to-1 leverage on a simple assets equity basis is not the sort of extreme leverage that was a hallmark of so many banks which ran into trouble during the global financial crisis. Instead, the bank was largely a victim of its own success. In the era of zero interest rate policy, part of Silicon's business model was locking tech employees and founders in, providing them with both commercial and personal loans if they agreed to bank with Silicon as their primary relationship. With all the liquidity that has sloshed through Silicon Valley over the past decade and a half, that meant a truly enormous deposit pool ended up building up in accounts of startups, venture capital firms, founders, and tech employees. As of Q4, roughly 93% of those balances were uninsured, which is in excess of $250K. With all those deposits, the bank bought a portfolio of interest-bearing bonds. Folks, bonds, particularly treasuries, had the worst year on record last year. At their respective peaks, the deposit pool was just shy of $200 billion, while the bond portfolio was $128 billion. The vast majorities of securities purchased with the inflows were long-term and, quote, held-to-maturity bonds. Bonds held to maturity are not marked to market, basically. A combination of rising interest rates, lower bond prices, and falling deposits with a broad slowdown in venture tech activity eventually meant that Silicon had to sell some of their held-to-maturity bonds and book losses. That led to more deposit outflows and eventually the failure of the bank. So essentially, folks, everybody panicked, right? You're a depositor, you have well over the FDIC maximum, and the bank, what was I think early last week, said they're going to try to raise $2.5 billion in equity, and you freak out, rightfully so, and you pull your deposits and you have this mess. They have to sell investments that have been marked down dramatically since they bought them, because they bought them at rock bottom interest rates. Really crazy that as a bank with so much exposure there that they apparently did nothing to hedge their interest rate risk. A friend of mine sent me a link to a podcast that featured Chris Whalen of Whalen Global Advisors, who's a very respected bank analyst out there. I typed some notes from that interview, so I'm just going to give you the gist of it here. So the interviewer asked, are all depositors going to remain whole? Whalen instantly said yes. Interviewer, officially all depositors are only insured up to $250,000. Unofficially, is everything insured? And then here's the gist of how Whalen answered that question. FDIC tends to pay out broker deposits at the close because they don't want to deal with them. They don't want the blowback from the markets for having broker deposits get crunched. But if you're a large depositor of the bank, say you're a business and you had big transaction balances, things like that, they're going to work very hard to get you paid quickly because they understand. And if they find a buyer for the bank who's willing to just assume all the deposits, then they can take care of that. It's going to evolve over time. But the thing I want to say to all the depositors of the bank is the FDIC is going to protect you. The other creditors, no. And I think if you're an equity holder of the bank, you're probably looking at a dead loss. So do we need to worry about a 2008 style banking crisis? Indications are, at least initially, no. That would be our position right here. So folks, certainly more to come on that. I am taking in the opinions of who I think are the smartest experts in the banking sector. So we may very well explore a bit more of that on the blog in the days to come. With that, I will leave it there. Hope you have a good weekend. I hope to come back to you one more time, as I said earlier, with a quick look at what's going on in the stock market and any other related markets that I think are worth looking at. So as always, thank you for watching and listening. Take care. Bye-bye.